Hello everyone, this is Ted Bauman here, editor of the Bauman Letter with your weekly Friday video for me. Today's topic is energy. I don't often talk about the energy markets themselves, the price of oil and things like that, but I'm very interested in energy as an economic factor and as something that affects all of us, and not just now, but is already calling into question some of the plans that we have, if you like, for the human race going forward for the next couple of decades. So let's start with the facts. Here's a chart that shows oil prices going back 20 years. And in recent days, we've seen the price of oil, West Texas Intermediate, above $80 a barrel. That is the highest level since 2014. I've marked the $100 a barrel level, which is the one that seems to trigger a lot of emotions. And the reason for that is because, as you'll see, that triggered a wave of economic activity when oil recovered back to $100 a barrel after 2009, and then something else happened. Now, that's not the only part of the energy market that's been crazy this year. Here's a chart of natural gas prices in different parts of the world. In the United States, not so much happening. There is an uptick, but not much. But look at Europe, look at Asia. I mean, that's just incredible. Imagine you use natural gas as the main form of energy for your, your heating. That's going to have a dramatic impact on households, governments, everybody, budgets, you name it. It's going to have a big impact, and it's already happening. Now, what about coal? Coal is supposed to be on the slag heap of history, as the economist puts it. But look what's happening with the price of coal. Here's the price of coal, but it's also the natural gas prices. These are futures, and you can see it's just going crazy. So the reality is that whereas we have spiking energy prices all around the world, we're not producing a lot more of these things. Here is the year-end inventory of electricity coal in the United States. Going back to 2014, you can see that we're way, way below any reasonable measure of where things used to be. So there's a big sea change going on. Now, what normally happens when there's a big change in energy demand when prices go up? Well, the market mechanism says when prices go up, you produce more, but not this time. A few years ago, in fact, when the price of oil hit that $100 a barrel level, companies started to invest in more production. In 2014, Royal Dutch Shell put more than $30 billion of money into new capital expenditure to increase output in upstream oil and gas projects. And then it spent another $53 billion to buy one of the biggest natural gas groups in Europe to become the world's biggest producer of that gas. What about this year? Well, this year Shell's upstream spending on capital spending on natural gas and oil is only about $8 billion. Look at the difference. You're looking at a difference of close to $85 billion in 2014 when price signals hit $100 a barrel, and now they're down to $8 billion a barrel. In fact, total global investment this year in oil and gas production will be down 26% from 2019 to just 356 billion. That's in the whole world. Now, just in the years 2010 to 2015, just exploration spending averaged about $100 billion a year. So that's a big chunk of what happens in investment. This year, it's down to around 50 billion. So it's fallen by 50%. Now, here's a chart that shows that drop in investment. You can see the oil and gas figures there, but really the big fall off happened when that $100 oil price collapsed in about 2015, 2016, and then prices began to fall. But here's the thing: look at the forecast band there. You see that we're in 2021 now. Despite these high prices, you don't see any real increase. Nothing appreciable, certainly nothing like what we saw between 2010 and 2015. Now, why is that? Well, it's one simple reason. The world needs to transition away from fossil fuels. We need to transition towards renewable fuels. And everywhere you look, people are putting pressure on these big energy companies to go carbon neutral, to reduce their investments in fossil fuels, and essentially to try to move as quickly as possible towards renewable energy. And here's the problem. The short-term result of that is that we are in a position where, because of underinvestment, at least relative to the past, over the last few years, combined with a reluctance to invest now, combined again with increasing demand for energy because of the rebound in the global economy from COVID, we're now seeing an energy crunch. And the problem is that this feeds into politics, and the politics of it are, well, it's all renewable energy's fault. This is all a terrible mistake. We can't do this. We have to go back to fossil fuels. We should be spending more money on that. I'm sure there are a lot of you who believe that. But that's catastrophically wrong, and it's basically unassailable that we do need to move in that direction. Here's the problem, and this is why things like public policy plays such a great role. In order to make a transition like this, you need to find a way to compensate for the short-term ups and downs that go with a transition, and you need to do it through a public policy that makes sense. It doesn't look like we're going to get that in the United States. It looks as though the one part of the Biden budget, the Democrat budget that was supposed to address this, is going to get dropped, thanks to the basically a decision by Senator Joseph Manchin of West Virginia, a coal state, saying, "I don't want it. I don't want a public policy that basically leads to people picking and choosing between fossil fuels and renewables." A catastrophic mistake. I'll stick my neck out there. That is a terrible mistake. And even if you don't believe in global heating or whatever you want to call it, the reality is that this is a market-driven phenomenon, as I'm going to show you. And if you don't prepare for it, if you don't guide it, if you don't plan for it, if you don't have public policy to support it, this is what you get: oil crises. Now, here's an interesting fact. The International Energy Agency, or IEA, says that the rebound in consumption of fossil fuels this year, in 2021, could lead to the second biggest absolute increase in carbon dioxide emissions ever recorded. In other words, from last year's baseline, where we had obviously very low consumption of fossil fuels because the economies of the world were shutting down to try to stop the spread of COVID, which failed. Now we're back to normal, actually beyond normal. And so as a result, we're getting this enormous spike in the use of fossil fuels. The problem is that this runs smack against the goals, which the International Energy Administration says basically there should be no new investment in new oil and gas projects after this year. Nada, zilch. Nobody should invest anymore in producing fossil fuels after 2021. Now, part of that is in order to meet climate goals, but the other part of it is simply that if we don't start now transferring investment from fossil fuel energy production to renewable energy production, we'll end up with a future world that is in many ways less habitable. Many cities around the world will be flooded. All these terrible things will happen. Again, you don't have to believe that stuff to know that the market is on the side of renewables. Now, some of the estimates are that in order to make this transition feasible, we would need to go from investing about $1.1 trillion every year in clean energy production, which is about what it is this year globally, to about 3.4 trillion a year between now and 2030. Here's a chart that shows the projected market size of energy technologies that would be required to meet zero emissions by 2050. And you can see oil is just a wasting asset. It cannot continue to play the role it plays. Interestingly enough, the market size in terms of money for solar and wind is actually not that big. The big increase is going to come in batteries, and that's because renewable energy doesn't work at systemic scale without storage, and that's why battery storage is so important. It's why, for example, at the Bauman Letter, we've invested in a company that plays a critical role in managing battery storage. It creates software and other management techniques that maximize the storage of batteries, or the storage of renewable energy in batteries. Now, here's another look at it. This comes from Brookfield Energy Partners. It shows essentially the growth in investment in renewable power generation. You would need to go from 300 billion, which is really, the figure I gave earlier, 1 trillion, involves other things like hydropower and whatnot, but this one is just pure renewable energy. To go from 300 billion to $3.5 trillion a year, every year over the next 30 years, that's what needs to happen. Now, the reason I point this out is because it's not just about wanting to cut back on the fossil fuels, right? It's not just a question of wanting to stop spewing carbon into the atmosphere. It's also to force everybody to start spending as rapidly as they possibly can to make this transition happen. And here's the big secret, and it's not a dirty secret, it's a clean secret. It's not about public policy. It's not about people, greenies and tree huggers. It's about the market. Here's a chart that shows wind and solar power, their current price levels relative to gas and coal. And right now, they are cheaper than both of those sources of energy. But look at where they're likely to go. I mean, nobody's going to be closing the gap between coal and gas and renewables anytime soon. Now, here's another chart that shows the result of that. This year, in 2021, for the first time since records were kept, renewable energy is actually a bigger part of U.S. consumption than fossil fuels, than coal. Now, you may wonder why renewable energy goes all the way back to the 1860s, when, of course, we didn't have solar and all that back then, and that's because that includes hydropower. And, of course, we have had hydropower for a long time. Now, what's interesting is that global energy, renewable energy capacity topped 1.5 million megawatts last year. It was only 55,000 megawatts in 2000. So just in 11 years, we've gone from 55,000 megawatts of renewable energy capacity to 1.5 million megawatts. The world added 280,000 new megawatts of renewable energy just last year. That was 45% more than in 2019. So the point of all this is to say that this is happening whether you like it or not. Even if you take government policy out of the equation, it's still going to happen. The problem is that if you take government policy out of the equation, it's going to be a rocky ride. And that is what we're seeing this year with high energy prices. Now let's look a little more closely at why that's the case. Let's focus in on natural gas. Now, natural gas is a critical part of the transitional phase between a fossil fuel-based energy regime and one that is primarily about renewables. And the reason for that is that, first of all, it's a cleaner way of producing energy than oil or coal, but it's also because it is something that it's flexible. In other words, you can move natural gas supplies around the world fairly easily. I mean, there are ships constantly at sea carrying liquid natural gas around the world. Now, the problem is that if you treat all fossil fuels the same, for example, oil and natural gas tend to come from the same sources. They're produced out of the ground together as part of the same process. In the old days, you used to see flares at drilling sites where they were drilling oil. They were flaring off the natural gas. Now they capture it. But the thing is, they both tend to come out of the ground together. So when a company like Shell decides to cut their investment in oil, they're also cutting their investment in natural gas. And that is one of the reasons why we have seen such a big spike in natural gas prices in Europe and Asia this year, because there has been a big cutback in that kind of investment. Now, if you look at countries like China, for example, gas is the main alternative to coal. And because of reduced supplies of gas, as a result of reduced drilling for gas, which goes along with oil, it's led to a spike in the price of coal there, which in turn has made that whole country's energy prices go nuts. I mean, I showed you the chart earlier showing what it has actually done to those prices. But the critical thing here is that in order to maintain the stability of the electrical grid, in the process of making a transition to fully renewable energy, you need to have natural gas. Now, I don't like that fact. I don't like the fact that we need to continue burning that type of fossil fuel to make the transition, but it needs to happen nonetheless. And public policy right now is not doing anything to help us get there, because essentially that public policy is being driven by, just a complete gridlock. We don't have on either one side or the other enough momentum to be able to have one win. We're at gridlock, particularly in the United States. Europe's a little different. China is very different. But we are one of the big influencers of global climate policy, whether we like it or not. Now, there's another very mundane reason why natural gas still has an important role to play, and that's because the price of natural gas tends to be the marginal price that is used to set power costs, even for renewable energies. Because until we have sufficient battery backup storage to be able to keep solar power and wind power on hand when the lights are out and when the wind's not blowing, then you need to have natural gas-fired backup generators in order to to keep the price, or rather to keep the supply constant. And that means that natural gas becomes the default benchmark price for those energy prices, even if the cost of production of things like solar and wind is a lot lower. So the problem we have today is that the world is not investing enough to meet its future energy needs through renewables, and it's also not investing anything in the old regime, which is the fossil fuel sector. Now, when it comes to coal and oil, that's inevitable. But natural gas is a bridging technology, which I believe, and I've been led to believe, and I think it makes a lot of sense that we need to have that bridging. The problem is that right now, because they tend to come from the same places as oil, in other words, the same kinds of wells, the same underground resources, if you stop drilling for oil, you stop producing natural gas. Now, am I saying we should keep drilling for oil? No. What I'm saying is, if you don't want these kind of energy crises to occur in the future, you need to have public policy that is reliable, that is long-term, that actually gives signals to the big companies that make these investments to know that there is a dependable future that they can invest towards. If they know that they can't invest in fossil fuels because they're not the future, they'll stop doing it. But unless there's a framework that actually gives us a way forward, they won't invest in renewables at the scale required either. The result, the energy crisis we have today. Now, how do I play this? Well, in the Bauman Letter, we've actually added a couple of major investments in companies that are essentially, their specialty is to create new renewable energy generation utilities. In other words, big scale solar, big scale wind, big scale hydropower. They create them, they finance them, they design them, they build them, and then they lease them out to regional power generators, and they collect a long-term income from those utilities over many years. That leads them to be able to pay really high dividends. And that's where I think a great place to put your money is, because those companies are already operating a profitable business model. Right? It's not speculative. We're not talking about coming up with some new battery technology. These are companies that are already profitable, that are already paying dividends in excess of 4 and 5%, that are growing rapidly and are going to probably return in the neighborhood of 15 to up to 20% combined annual growth over long periods, when you take into account their revenue growth as they create new utilities and their dividend growth as they take money from them. So if the governments are not going to get it together, you can by looking at these big utility scale companies. If you like to see them, you can certainly find them on yourself, or you could subscribe to the Bauman Letter for a very cheap $49 a year and find out my recommendations. I'll talk to you next week. Bye-bye.